Denise, so good to have you on. Hello, everyone. Happy Wellness Wednesday. I hope everyone is doing fantastic tonight. It's raining over here in New York, but hopefully some of you are enjoying some very nice weather wherever you are joining in from. So I'm going to give everyone a few minutes to get in, but thank you, Denise, for joining me on Zoom. Also, thank you for those of you who are joining on YouTube. Feel free to use the chat to ask any questions that you have, whether it's on YouTube or on Zoom, because I love the questions. The questions make everything so much fun. So, and thank you to everyone who joins on the replay. So, if you haven't, please remember to like, subscribe, and share on YouTube. That allows us to get this education out to more people because more people need to know these things, right? It's no need to keep wonderful things a secret. All right, everyone. So today we are talking about Chapter 9, Design Your Plan Properly. Now, I have already been kind of talking about this all along, the importance of designing your life insurance properly to get the most out of it. And, you know, I personally have life insurance. I definitely believe in it as a way to create generational wealth, leave a legacy. And obviously there's other benefits that, our life insurance can have while we're living, right? And so there's things like long-term care. Also, obviously, as the author has been speaking about, the option to use your cash value for retirement. Okay. So that's another thing too, because you can get it tax-free when you withdraw. So that's really, really important to know. So let's jump in today. If anyone has any questions that they want to start out with, feel free to drop them in the chat. Hey, Jen, welcome, welcome. All right, so we're on Chapter 9, Design Your Plan Properly. So this is my favorite part. And so this is really important too. If you already have a policy and you want to make sure it's designed properly, these are some things to look out for. So if you have a Kindle book, it starts on page 125. So he says, not all policies are created equal. And this is indeed true because what I've had to explain to clients is that if you opt for the absolute lowest premium, that's the monthly amount that you pay, right? Or depending on how you set it up, then you are not going to get the results that you want. So let me make that disclaimer right now because everyone's like, people don't want to pay for it, but they don't realize how that ultimately impacts their results, right? So I really believe it's important to understand the value and why it has the amount of premium that it has. I think that's really crucial to understand. He was like, not all companies are equal and not all agents are equal. And so I've told clients before, like if they actually have something that is set up properly, I will tell them to keep what they have. There's no need to change it. But I'll also let them know if there's anything missing from it. So one thing I really like how he broke down on this is also on page 125. He says, ensure your full human life value. Now you might be like me. When I read that, I was like, how can you determine the value of a human life, right? Because when an insurance company is deciding whether to insure you or not, because first of all, everybody doesn't qualify for life insurance. Put a 1 in the chat if you already knew that. Not everyone qualifies for life insurance. That's important to know. There are guaranteed issued companies, but not everybody knew. Okay, very good. Thank you, Denise. Everybody doesn't qualify. And then some plans last until you're 100 and some plans last until you're 120 or 121 because people are living for a long time. So he says to make optimally funded whole life break even on cash flow as quickly as possible, right? So if you're looking to basically use your cash value very early on in the policy, what you want to do, here's the secret. The secret is in the book. I'm giving y'all the tea. You want to get a low amount of life insurance and then optimally fund your policy as much as you can. What are you talking about, Mia? What do you mean by that? So, what I mean is, okay, maybe you want $1 million policy, right? but $1 million of life insurance coverage is going to cost, correct? Now, what if you designed it where you get a lower amount of insurance, but you maximum fund to the amount that you can, right? It may even reach up to the amount that you would have paid for 1 million, but instead of paying the cost of insurance, and I'm gonna say this slowly, instead of paying for the full cost of insurance, the cost to have 1 million, you get a lower amount. You pay the amount in as if you had 1 million, and you're gonna see a cash value explode exponentially. That is the secret. Boom, right there. Period. Period. Like that's it. That's the way. So, but before you do that, though, okay, this is really important. He says it's in the book, and I also believe this as well, especially if you have dependents, or people depending on your income or anything like that. Before you consider optimally funded life insurance, you want to maximize your insurance protection. So you might actually need that $1 million, depending on what is important to your family. And how do we determine what you need? So I use this equation with my clients, and I'm just going to see if I can share it on a whiteboard. I think I can because I'm on Zoom and it's good to have visuals. So hopefully, let me know, can you see the whiteboard? Let me know if y'all can see it. Okay, where's my text? Here we go. So when you're thinking about how much life insurance you need, I use this method called DIME. Okay. Oh yeah, looks like it's working. Okay. DIME. What does DIME stand for? It stands for death expenses or final expenses in debt. It stands for inheritance and income. It stands for mortgage, and I'm gonna break this down, and then education. Okay. So if these are, ooh, okay. Um, looks like, let's see, host tools for, okay. Host only. Yep. Okay, there we go. There we go. All right. So hopefully y'all can see this clearly. So when you're looking at how much insurance you actually need, you want to think about death expenses. So how much if you want to have a funeral or be cremated. And then if you are in a relationship, you have a spouse and there's debt that both of you are co-responsible for equally. Um, yes, is it more zoomed in now, Jen? I think here we go. So this is D. So this is the acronym to determine how much life insurance you need. Okay. So this is funeral or cremation or whatever you choose. And then any debt, and sorry about these lines, I don't know what something weird was going on there. Or any debt that you and maybe your spouse are responsible for together that would need to be paid off when one or more of you, either one of you passes away. Okay. So that you'll put those numbers here under D. Oh, Denise, it keeps drawing on the screen, so I don't know if not sure how to stop that. Let me see if I can get rid of these marks. But I think everyone can see it okay. The other thing is inheritance and income. Okay. So inheritance. So let's say you don't have young children. Maybe you have two kids and you want to leave a $250,000 to each of them. So if you have two kids, $250,000 each, then that's $250,000, right? So right there, that's 500,000. Or if you have people that are dependent on your income, welcome Olympia, then you are going to want to determine how many years of your income would you want to leave behind so that your family, while they're grieving, can still continue to maintain their lifestyle, right? Especially if you have young children or a spouse that's dependent on your income to live. And the next one is mortgage. So if you have an outstanding mortgage balance, and then the other one is education. Now, these two, I don't education for minor children, right? So if you have like five, 5, 6 year olds, really young children, you may want to have a portion dedicated for education for them, in case you were to pass away prematurely. Now, for these two, you may not want to have all of it as permanent coverage. You can have those as term coverage because eventually the mortgage will be paid off and eventually your children will grow up. So that's something to consider. So I hope, hey Errol, what's up? So what I do is I help my clients decide, does all of this need to be permanent coverage, or do we want a portion permanent and a portion term, right? So it really is designed to fit your needs as an individual and as a family. Okay. So any questions about that so far? Let me know if you have questions about the formula. Or you may not have any of this because when I decided on my life insurance personally, I did it because I wanted long-term care. So for those of you who are not familiar with long-term care, that just means that you cannot perform 2 out of 6 activities of daily living and for 90 days or more. And now you need some type of assistance, whether it's a family member taking care of you, whether you're in a nursing home, it could be an adult daycare, and you can use funds from your life insurance policy to take care of that. Now, why is that important? Because in this country, right now, long-term care, depending on what state you live in, can cost $7,000 to $10,000 a month. And if you're pulling that from your assets and you still have a mortgage and other financial responsibilities, that can drain your assets pretty rapidly. So this protects you in a sense of you having another bucket of money that you can draw from. Okay. So human life value. Let's get back to that. That's where we were. Human life value means that your total insurable value based on your earning history and potential. Okay. So obviously, it's not just about finances. When you look at human value, obviously, it's about who you are as a person and what have you. But when an insurance company is thinking about your human life value, that's what they look at to determine, whether or not you qualify, right? Well, that's one portion of it that you want to protect. And the other thing too is like here in New York, when I'm helping clients set up life insurance, they don't allow you to have more than 15 times your income. So I have clients that have multiple life insurance policies. They have one policy that is, making sure it takes care of all of this, but then they have another policy for optimally fund it so they can do this Rockefeller method. So you can have more than one policy. Everything can have a different purpose, right? It just has to fall within certain suitability guidelines. Any questions so far? So I'm going to stop this whiteboard. We're going to get back to the book. All right. Awesome. So, one thing to understand, that's why when I talked about like the maximum amount of insurance you can have, because like insurance companies, for example, if you have a home, car, they're not going to over insure you. Like if the car is only worth $50,000, they're not going to insure you for $75,000, right? And so that's the same thing kind of like with our lives, so to speak. So in essence, to wrap this part up, let's talk about, or to move on from here, let's move into the optimally funding your policy. Anybody ready to talk about how to optimally fund your policy? Let me know in the chat if you're ready for that. You want to know what that means. And I'm going to explain it to you in 2 different ways, right? Because he is all about whole life, but I also want to share Index Universal Life with you all because I know that many of you are familiar with that. You may have seen it on social media or heard about it from others. So what does optimally funding mean? This means that you put extra money into your policy. Boom, easy, simple, right? But remember, you have tax advantages on your permanent life insurance policies. So there is a cap, similar to when you fund your 401k at work or your traditional IRA, Roth IRA, there's a cap, an annual cap, right? So if you have a whole life policy Any additional premium dollars is what's called paid up additions. Okay, paid up additions. That's really important to know. So he says this money supports the growth of the policy so that your internal rate of return is accelerated in the early years of the policy instead of you having to wait 10 or 12 years or longer to see a positive yield on your money. So if you front load up front, you'll get to use your money faster. Because remember, with a life insurance policy, it doesn't have the same restrictions as your retirement accounts do at work. And that's important to know. So when you pay in, it increases your cash value more quickly, and it also increases your death benefit. Pretty simple and straightforward. Okay. Another thing that you can do, like with my clients that do IULs, is that you can put in a lump sum. So if you have like 10, 20, $30,000 sitting in a regular savings account, making 0.01%, you could put that into your policy and actually make somewhere between 4 and 8% on it a year. Okay. So that's important for you to know. But there are limits. So anytime you're going to do this, like the companies that I work with, they don't let you go above your max, because if once you go above your max, you lose the tax privileges. And that is what you call a MEC, a modified endowment contract. You do not want a modified endowment contract because it defeats the purpose of what you're doing with your policy. It takes away the tax privileges. So if you have the Kindle book, MEC is on page 129. Okay. So that is really important to understand. How much can I max fund this account? So you may be paying in, like I have a client, her minimum, well, not her minimum. So I never tell clients to pay the minimum. There's 3 numbers on in your life insurance policy. There's the absolute minimum that you can put in to be able to fund your policy, right? You're not going to see any growth with the cash value. But if you like, I just don't want the policy to lapse, there's the minimum. Then there's a middle number. So this is like the ideal number where you're going to take care of the cost of insurance, but you're also going to see the cash value growing. And then there's the ceiling. So the number between the middle number and the ceiling, that's your sweet spot. That's where you can actually really get in there and start to see your cash value growing. All right, any questions so far? Yeah, 0.01 is not worth it. Not at all, Jen. So Jen is saying in the YouTube land, 0.01 return in a savings account is not worth it. You could put it into your policy and optimally fund it. And so that's what one of my clients does with her kids. When they get a certain amount in the savings account, she then moves it into their life insurance. And for those of you who have children, you can actually start these plans with kids as young as 15 days old. So yes, have a UTMA account for them, but also think about getting them a life insurance policy, because it's going to be, because they're younger and they're healthier typically, this is going to be the lowest premium that you can put them in. So the faster you can start it, the earlier, I should say, the better off. Next thing he says the best method is to put as much into your policy as your cash flow will allow. Building to 15% of your income is ideal, but the most important thing is to get started. And eventually you can decide that you don't even want to pay premiums on your policy anymore. So typically, depending on when my clients start, I actually design their policy where they stop paying in at traditional retirement age, like 65. But if you front load it earlier on in life, you can even stop paying before then. So you don't have to pay. Like, I know one of my clients was like, well, I don't want to pay until I'm 100. And I was like, you don't have to pay until you're 100. I was like, where'd you get that from? And so there are whole life policies called Whole Life 100 where you pay until you're 100. But people do that because they can't afford to pay the premium in a shorter amount of time. So again, there's many ways in which you can design this. So if you're having a conversation with an insurance professional, this is important for you to kind of know these things. Hopefully you're talking to me because I'm going to tell you what it is. But if you already have an insurance professional that you're working with, these are some questions that you can ask them, or you can come to the table with and be able to have a, a intelligent conversation about it and understand everything. So you don't you can stop your premium payments, right? And your cash value can be used to cover the cost of insurance. So that's really important to know. The other thing is that how insurance companies are on the hook. So for your death benefit. Thank you, Jen. Jen says talk to me. And I will actually I will put it in both chats, but my website, if you want to book a complimentary consultation, I don't only do life insurance, I also do guaranteed lifetime income for retirement, right? If you want to create your own pension and know exactly how much money you're going to get every month in retirement, that's something else that I do. Um, Basically, life insurance companies, they have to hold on to your first year's base premium for 10 years. Because let's say that you only made two life insurance payments and you have $1 million policy. Well, guess what? They got to pay your beneficiaries that $1 million, even if you only made two payments. So they have to be in the business of being fiscally responsible. Yes, they may invest money, but they have to have strong cash reserves. So when you're thinking about what companies that you want to work with, you want to make sure that they are A-rated companies and they have strong cash reserves. That is crucial so that those claims will be paid out. Okay. So there's two different types of companies. I'm not going to go into that. It's on page 130 of the book, but here's some things to think about when you're choosing a company. I already told you about the A rating, and that's across the three boards that rate insurance companies. Okay, it's Moody's, AM Best, Standard and Poor's. Um, Make sure it's an A-rated company. The other thing is you want to make sure that these companies have been in business for 100 plus years or more. Those are the companies I work with. Like, I want to know that they've been around, they're paying claims. The other thing is if you're doing whole life, the dividend history, or if you're doing an IUL, you want to look at the index crediting rate. And then the last thing is loan provisions. Okay. So with loan provisions, if you decide to take a loan, which you can from your policy, is there a fixed interest rate? How much of the interest goes to the company and how much of the interest comes to you? Because with my company that I have my policy through, for example, if I take a loan, half of the interest comes to me. So I'm paying myself back, right? That's that whole infinite banking, be your own bank thing. So those are the four things you want to look for. And I'll share my screen really quickly in case y'all want to take a snapshot of that. If you don't have the book, because I'm mostly on Kindle, like I have a book problem. So I had to like stop with buying books, physical books. But these are the four things you want to think about. The only difference with, like I said, with the IUL, it doesn't do dividends. It credits you based on the performance of the index. Okay, and you can look at the rate of return. So I actually had a client, her last rate of return was 11%. She was like, "What?" And I was like, "Yeah, look at the numbers year over year." So she was very happy about that, needless to say. Excellent question. So Jen asked, where do we find out what our policy's loan provisions are within our policy? So it is either going to be in your original policy contract, because a life insurance and annuities, those are contracts. So the company is on the hook for what's in the contract, right? As long as you meet your end of the bargain. So it's either going to be there, or you can just give them a call and say, what are my rates? Because I know with my company that I have my life insurance through, after 10 years of having your policy, um, the even though they charge you interest, you get 100% of the interest back after 10 years of having a policy. So yeah, I know, right? I was shocked too. I was like, "Oh, girl, you did your policy did great." Because what I do is I actually look at the indices that I have my clients tracking, and I'm like, "Oh, let's change index strategies because this index is performing better than this index." So I'm actually actively looking at these things, right? This is really important. Because if you're not looking at it, you want somebody who is looking at it for you. All right. So, ooh, we only have 5 minutes left, but I think we can get through here. Um, let's see, anything else that's important? Okay, here's the next part of this other things to look for when you are deciding on a company. If you decide to go the term route, you want to make sure that your term policies are convertible and what is the timeline for conversion. If you can, I recommend doing it within the first 5 years. Um, and also you want to if you can, if you qualify a term policy that doesn't require a medical if you decide to convert, meaning they're like you're already a client, right? You already were approved. Like let's say, God forbid, within the first 5 years, you're diagnosed with cancer, right? Obviously, you won't qualify for a new plan, but, right, unless you're on a group, but we're not talking about group here because that's not helping us with our legacy. If you have a term that's convertible, then you can convert it to permanent, knowing, that you have cancer because they won't do a medical. That's not every company does that, but that's something you want to think about, right? The other thing is high early cash value. How soon can you access the cash, right? And I already told you some tricks and tips on, it's not a trick, it's like actually what you do. But I already gave you some tips on how to get high early cash value. And then no barriers for paid up additions. Paid up additions is only for whole life. So that's important for you to know. And so these are some things to think about when you are considering your policy, okay, or the companies to work with. Any questions so far? So we have about 3 minutes left. Oh, we actually got through the whole entire chapter. Well, the highlights. But I would love to know if anyone has any questions, like in the chat, let me know. Anything that came up for you that you're curious about. I would love to answer some questions. Because I like this to be more of a dialogue and, and this is a judgment-free zone, safe space for us to discuss. So let's see. Okay, I don't see anything here. All right, so I don't see any questions today, but I will tell you for next week, we are going to be talking about how to find the money to fund your life and legacy. So this is really great because how will my clients do is they'll start where they can, and then from there, they will go, then as they get extra money, they'll use that to fund. So Errol says, what type of insurance grows cash value the fastest? So I have access to a policy called High Early Cash Value. It's a permanent policy, it's an IUL. And the fastest way to really get it to grow is either doing a lump sum or, like I said earlier, you can do a smaller death benefit because your primary goal is to grow the cash, and then you max fund it, right, with as much as you can. So, yep, that is the fastest way to grow your cash value, or that's the type, is with the higher early cash value IUL. Thanks for that question, Errol. All right. Ooh, let's see if I have a question over there. Oh, thank you, Olympia. Awesome. Well, I want to say thank you all for coming. I know that this is a lot of very heavy, lot of information. I don't want to say it's heavy, but I want to normalize these conversations in our community because chances are, unless you have like like a $25,000 policy over a long period of time, chances are you'll never pay in to your policy as much as you or your beneficiaries will get out. So the return on, it's not an investment unless it's a VUL, which is variable universal life or something like that. But the return that you get typically outweighs, what you put in. There's some really great rates of return, and it's a great way to establish legacy for the next generation. So with that being said, right? Because I'll just say this. How many of you would love, because I know I would, just to be, God forbid your loved one passes on and then you're left with $1 million, $500,000. Like, how would that change your life? I mean, just think about it, right? Somebody thought about you enough to put you as a beneficiary on a 500,000, 250,000, $1 million policy. Like I know my life would shift tremendously in terms of, my philanthropy work and things that I could do. So, whose life might you change, right? It could be yours, right? And then the next generation. So with that, everyone, I wish you all a great night. Thanks for coming. Thanks for joining me on Zoom. Thank you, Olympia and Denise. And great to see you, Errol and Jen, on YouTube. And I look forward to seeing you all next week.